Good day. I'm Abolore. On today's episode, we'll be looking at accounting error as a topic. So, without much ado, let's dive into action. So, when we say accounting error, there are those mistakes or misrepresentation that are made by the accountants in the preparation of financial statements. So, this topic points to the fact that no one is infallible. No one is above making a mistake, basically. So while the accountant prepares the financial statements, he or she may, commits errors intentionally or unintentionally. And this is basically what we mean. Let's say as an accountant, you want to record in the books of accounts 5,000 naira, and you went ahead to record 500 naira. So this is an error. And this type of error is mostly ascribed to be quantitative error. But the qualitative error, that one is, or that has to do with recording in different accounts. Let's say you want to record in Bola's account. Then you went ahead to record in, let's say, Bolu's account. So this type of error now, you want to record in Bola's account, then you went ahead to record in Bolu's account. This one is qualitative error. So it has to do with name, recording in different accounts. That's name now, with respect to this. But with respect to this, that's figure. Anything that has to do with figure is quantitative error. So that's that. Now, with respect to error, error can be committed intentionally or unintentionally. When error is intentional, it means the accountant commits the error for his or her own advantage. And intentional error is the same thing as fraud. And don't forget, fraud is tantamount to imprisonment. That means, as an accountant, if you commit an error intentionally and you are found guilty of that, then it means such an accountant may be behind bars. That means doing time. It's such an accountant will definitely be in jail. That's what we mean by that. So unintentional error, on the other hand, is when the error is not committed intentionally, and most times we usually refer to that as a mere mistake. But also, as an accountant, you have to make sure every time you record, you make sure you display your professional ingenuity, because unintentional error, which has been committed by an accountant, must, the accountant must be able to prove beyond reasonable doubt that such an error wasn't committed intentionally, because the management of the business organization solely relies on you regarding the records of their business organization. So as an accountant, you must make sure that you display your professional ingenuity when it comes to keeping records or documentation of records in your business organization. So error can be intentional or unintentional. Now, this topic, accounting error, most times is not often treated in isolation. And that simply explains that treating of error as a topic is usually ascribed to trial balance as one of the bases of financial accounting. Like, I mean, a topic, trial balance is one of the bases of financial accounting. Now, we usually talk about vehicular chain of business transaction. Don't forget, when postings are made from the subsidiary book into the ledgers, and from the ledgers we extract a trial balance. Most times there might have been errors in the ledgers. Then those errors would definitely appear when the trial balance is extracted. So this is what we basically mean. When the trial balance is eventually extracted in order to prepare the financial statement of a business organization, the trial balance, don't forget, I did say postings will be made from the subsidiary books into the ledger. Then from the ledger, trial balance will be extracted. So trial balance is basically used to test the arithmetical accuracy of the postings that have been made in the ledgers. So most times when the trial balance is extracted, It is used to test the arithmetical accuracy of the persons in the ledger. So at times, the trial balance may agree. That means the debit and the credit side of the trial balance may be the same. And at times, the two sides of the trial balance may not be the same. So what we mean actually by the fact that the two sides of the trial balance are the same is that the two sides of the trial balance being the same doesn't mean there are no errors in the books. There are errors, and it's just because the trial balance is used to test only the arithmetical accuracy of the persons in the ledger and not basically to detect whether there have been errors in the ledger and all that. And also, when the trial balance is extracted and the two sides are not the same, it's obviously means that there are errors in the books. So today, we're going to be looking at errors which affect the trial balance and which doesn't affect the trial balance. So errors now, accounting errors, can be classified or categorized into two. The first, which you are going to be looking at regarding today's episode. So error now, okay? So error now can be classified into errors that affect, errors that affect the agreement, the agreement of the trial balance, and errors that do not affect the agreement of the trial balance. So these are the two grouping of errors. So we have errors that affect the agreement of the trial balance and errors that do not affect the agreement of the trial balance. So this most times could also be referred to as errors that the trial balance will disclose. That's this. Or errors that will distort the agreement of the trial balance. That's this. And this is often referred to as errors that will not be disclosed by the trial balance or errors that will not affect the agreement of the trial balance. So when these errors occur, the agreement of the trial balance will not be affected. That means the two sides will be equal. But when any of these errors occurs, then it means the two sides of the trial balance will not be the same. It's either the debit side is greater than the credit side, or the credit side is greater than the debit side. And the difference most times when we have any one of these errors occur, it means the two sides of the trial balance will not be the same. So the difference most times on either debit or credit is often stated in the suspense account. So regarding today, we are going to be looking at errors that do not affect the agreement of the trial balance. So let's list some of these errors now. So let's talk about this, okay? So regarding today's episode, on today's episode, we are going to be looking at errors that do not affect the agreement of the trial balance. We are going to be listing them one by one and explain them, as well as you know, take looking at how those errors will be corrected when any of those errors occurs. So we have errors, errors that do not affect the agreement of the trial balance. So this is basically what we mean. When any of these errors occurs, you will have the trial balance, the two sides. That's, let's say, debit, credit. You will have the two sides of the trial balance to be the same. Let's say here 200 debit side total. Then you have a debit side total. So this doesn't mean there are no errors. There are errors, but these errors which have occurred and were not shown by the trial balance are this. So there are those errors that will not be disclosed by the trial balance. So let's list some of them and talk about them one after the other. So the first we have is error of omission. So error of omission now. Let's talk about error of omission. So error of omission occurs when a business transaction has been completely omitted from the books of accounts. And in other words, error of omission in other words means a transaction has not been recorded in the books of accounts. And it means no debit entry whatsoever in the books of accounts and no credit entry whatsoever in the books of accounts. So error of omission, when it occurs, it means the debit entry and the credit entry were not passed at all in the books of account, were nowhere to be found in any of the books of account. So in that regard, it doesn't reflect at all in the books of the accounts. That's what it means. So to correct error of omission, correction now, is just for you to pass the two entries for the transaction given, or for the transaction which has been omitted from the books of account. So let's say, for example, we have uh, cash sales. Cash sales, 100 naira, was omitted, omitted from the books, omitted from the books. So in this regard now, if you want to correct this error of omission, all you have to do is debit your cash account and credit your sales account. So for better understanding of this topic called error or accounting error, please, I would advise you make reference to uh, trial balance as a topic, as well as double entry system of accounting. We have done a video on those two topics. So with the knowledge of those two topics, you'll be able to understand this topic very well. So please go watch those videos, then you can come back to watching accounting error as a topic here. Or perhaps you could watch this, then you go back to watching that. Perhaps, you know, you will definitely, it will definitely enhance your understanding. That's basically what I'm trying to say. If you watch those two videos before you watch this. So if you want to correct this error, debit cash accounts and you credit sales, credit sales. So that's the correction of error of omission. So I repeat, error of omission occurs when a business transaction has been completely omitted from the books. No debit entry, no credit entry was made regarding a transaction that had occurred uh, as regards a business or organization. So that's error of omission. So let's go to number two now. Number two, that's error of commission. Error of commission, that's number two. So when error of commission occurs, the agreements of the trial balance will not be affected. So error of commission occurs when a transaction has been recorded in the wrong account, but the two accounts involved belong to the same class of accounts. The two accounts involved belong to the same class of account. This is what we basically mean by that. Let's say there is a transaction, basically. Let's say paid Bolu by cash, 20 naira. There is a transaction, paid Bolu by cash, 20 naira. Now, the entries that are to be passed regarding this transaction is debit Bolu and credit cash. That's the entries. But okay, let's try and explain the error that has occurred here. So here we have, this is cash account and this is Bolu's account. Bolu's account. So cash account to be credited with 20 naira. Then Bolu's account ought to be debited with 20 naira as well. But the 20 naira in Bolu's account was not made, the debit entry in Bolu's account. Then the bookkeeper went ahead to debit Bola's account. So the bookkeeper went ahead to debit Bola's account with 20 naira instead of Bolu's account. That's the error. And what that simply means is that Bolu's and Bola's accounts are both, they belong to the same class of account. They are both personal accounts. That's accounts of individuals or persons. So they are both accounts of persons. So instead of you recording in Bolu, debiting Bolu, you went ahead to debit Bola's account. That's error of commission. When a transaction had been recorded in the wrong account, but the two accounts involved belong to the same class of accounts. And don't forget, something I need to correct here, a notion I need to correct here. Most people usually think error of commission only relates to personal accounts. No, it also relates to, don't forget, account is classified into two, personal and impersonal. And impersonal is further classified into nominal and real accounts. So nominal accounts are accounts of income, expenses, and intangible assets. And real account is accounts of tangible nature. So if, for example, you want to record in wages accounts and you went ahead to record in insurance accounts, let's say you want to debit wages account and you went ahead to debit insurance, it is still error of commission because these two accounts belong to the same class of account, which is nominal account. They are both expenses. Or you want to record in, let's say, excuse me, let's say you want to record in office furniture account, then you went ahead to debit plants and machinery accounts. This is also error of commission because these two accounts belong to the same class of account, which are, they are both real accounts. That's what we mean by that. So you want to debit furniture, you went ahead to debit plant and machinery. The error which you have committed is error of commission. So to correct this error of commission now, Bolu's account, no entry was made, and the entry ought to have been made here, but it was made in Bola's account. So to correct this now, you will have to credit Bola's account. When you credit Bola's account with this same amount, it means that will cancel out the effect of this debit entry. So this will cancel out because Bola has nothing to do with this transaction here. So you pass the credit entry, this will cancel out this, then nothing will be in Bola's account. Then the corresponding debit entry of this credit entry which had been made here, the corresponding debit entry of this credit entry that had been made here will come to Bolu's account. So the error had been corrected that way. So you can see now that it will not go to suspense accounts. So correcting this error, credits Bola's account, which had nothing to do with this transaction. Then the corresponding debit entry of this credit entry, which had been made in Bola's account, will be made in Bolu's account. That is the corresponding debit entry. And don't forget your double entry principle. For every debit entry, there must be a corresponding credit entry. And for every credit entry, there must be a corresponding debit entry. So the corresponding debit entry of this will be made here. And that's with respect to that. So the recording in cash account is intact. Nothing, this is not affected. But only that what ought to be debited in Bolu's account was debited in Bola's account. That's that. So I hope that is understood. Good. So let's take the next one. So error of commission, like I said, that notion of is only applicable to personal accounts. No, it could also be nominal or real accounts. So let's move on. Then 3 now, we have error of principle. Principle. Error of principle and error of commission, they are kind of similar, but they are different. Yeah. So error of principle occurs when a transaction had been recorded in the wrong accounts, but the two accounts involved belong to different class of accounts. So this principle belongs to the two accounts belongs to different class of accounts. Why for commission they belong to the same class of account? That's just the difference. But it's still based on the fact that a wrong transaction had been recorded in the wrong account for these two. But the wrong account which was the transaction was recorded, and the accounts which ought to have been the transaction ought to have been recorded, they belong to the same class of accounts. But here they belong to different class of accounts. So let's take an example regarding that. Let's say uh, office expenses, office expenses paid by cash, 10 naira. Look at this. Office expenses paid by cash, 10 naira. So the two accounts in this transaction is office expenses and cash accounts. So here, office expenses will be debited and cash accounts will be credited. That's the entries that will be passed regarding this transaction. So cash accounts have been credited. Cash accounts have been credited with 10 naira. But the corresponding debit entry in office expenses was now made. This is office expenses. Office expenses. Then this is, we have office furniture. Look at this. Office furniture. The debit entry that ought to have been made in office expenses was now made in office furniture accounts. So instead of the debit entry to be here, then it was now made in the office furniture. You can see now, these two accounts, office expenses and office furniture, they belong to different class of accounts. This is a nominal account item, while this is a real account item. That's why most times error of principle is also explained to be when an item of nominal nature is recorded in real accounts and vice versa. That means when an item of real accounts is recorded in nominal accounts. And real accounts are accounts of tangible nature. It can be seen and touched. Furniture and fitting, plant and machinery, motor vehicle, delivery van, those are real, but nominal of expenses, incomes, losses, and all that. That's with respect to an intangible asset. That's with respect to nominal. So what ought to have been debited here was debited in furniture account or office furniture account. So to correct this error now, correction now. Office furniture has nothing to do with this transaction. So how do we cancel out this record in here, which was made wrongly in office furniture? So we credit it. We credit office furniture, and this we cancel out this. Then the corresponding debit entry of this credit entry that had been made in office furniture account will be made in office expenses account. So you have 10 naira here. Don't forget, for every credit entry, there must be a corresponding debit entry. And for every debit entry, there must be a corresponding credit entry. That's that. So nothing will be in office or furniture account. Then the debit entry, which ordinarily ought to have been made in office expenses, has been made now, which is 10 naira. So credit entry in the cash account, debit entry in office expenses account. That's with respect to that. So I hope this is understood. So the effects of this will not result or will not find their destination in the suspense account. No, no suspense account, because you have credited office furniture and debit office expenses account. So that's that. So let's go to the next one. So for now, we have error of original entry. Error of original entry. So error of original entry is also very interesting to understand, because it will lead to either overcast or undercast. Now, error of original entry from the word original, because most times you all know your subsidiary books. They are also called books of original entry or books of prime entry. So this error is had been made in the books of original entry, one of the books of original entry. So error of original entry occurs when a wrong amount has been used to complete the double entry for a business transaction. It had been used to complete the double entry for the transaction, and no, you know, uh, it wasn't realized by the accountants, and it's been used to finalize the accounts of the business organization. So that's basically that. So let me paint a picture of how that occurs. Look at this. Let's say, for example, we have purchases day book. You know your purchases day book, dates, particulars, then you have amount. Purchases day book is the subsidiary book used to record goods bought on credits. So all goods bought on credits will be recorded in the purchases day book. Then let's say the total of this purchases day book here. Let's say 200, 300, then we have 100. Look at this, 100. Then the total here, that's 600. This 600 is the total purchases is the total in purchases table, and this amount will be debited in the purchases account. So purchases account, it will be debited. Then the corresponding entry will be in suppliers account. That means suppliers account will be credited with this 600 naira. That's what it means. So here now you have purchases accounts, then you have suppliers accounts, because you are purchasing from the supplier or creditor basically. So this is suppliers accounts, this is purchases accounts. So this is error of original entry. Instead of you debiting purchases with 600 naira, then you went ahead to debit purchases with, let's say, 60 naira. Look at this. And instead of it to credit supplier with 600 naira, you went ahead to credit supplier with 60 naira. That's the error of complete reversal of entry. So you have, this is a case of you have reduced the figure from 600 to 60 naira in both accounts. So you have used this to complete the double entry for the transaction. So like I did say, error of original entry will lead to overcast or undercast. So in this case now, you have undercast the figure by, okay, let's get that together. That's 600 minus 60. That gives you 540. So the two accounts had been overcast by 540. You have reduced this supplier's account by 540, and you've also reduced your purchases account by 540. So correction now, let's correct this error which had occurred in these two accounts, which is error of original entry. So the supplier's account has been reduced. You need to increase it. The purchases account has been reduced by this amount, and you need to increase it. Now, something you need to pay attention here, very important, you need to pay attention. Supplier's account is the same as creditor's account, and creditor is a component of current liability. Now, liabilities are always credited. If you go by your trial balance, golden rule of trial balance, which I did emphasize that you should go watch the video on trial balance, it will enhance your understanding of this. Creditor is a component of current liability, and all liabilities are credited. Now, since supply is a liability account, is a creditor account, if an account has a credit balance and you want to increase it, you credit it more. So this account has a credit balance ordinarily. So if you want to increase the figure, you credit it. So you are going to credit it with 540. Then when you credit it with 540, it means the balance in this account now is now 600. So if you want to balance, then you also, purchases account is an expenses account, and all expenses accounts are debited. So if an account has a debit balance and you want to increase it, you are going to debit it more. And if an account has a debit balance and you want to reduce it, you are going to credit it more. So if you want to increase this purchases account, You debit it with 540 naira. Then if you want to balance up this account, this is 600. Then you have your balance carried down here. Balance carried down. That's 600. Then the total is 600. If you want to balance this supplier's account, the total is 600. Then balance carried down. That's 600. Then you have the total to be 600. So this is what you have. So you have successfully overstate the accounts to be 600 by adding 540 to it, as well as purchases. So that's with respect to that. So error of original entry will either lead to overcast or undercast. But with respect to this, it's undercast, because instead of you recording 600 in purchases and suppliers, you've ended up recording 60 naira, and that means the two accounts have been undercast, and we have been able to overcast it by the amount of which the two accounts are being undercast. And if the let's say you want to record 600, okay, here we said we want to record 600. If you go ahead to record 6,000, that means it had been overcast. Then you correct it as we have stated earlier on. So if it is 6,000 and you wanted to record 600, it means the amount must have been overcast by 5,400, I guess. So this 5,400, you will reduce this account, because 6,000 will be here. You reduce it by putting that 5,400 here, and you reduce this by putting the 5,400 on the debit side. So with that, you will still come down to the 600, which is the balance carried down, and balance carried down to balance carried down of 600. Then the balance carried down, balance brought down. Then balance carried down, balance brought down. So you will still have 600, 600. That's on the credit side and on the debit side. That's what you have. So that's the correction of error of original entry. So error of original entry, I repeat, occurs when a wrong amount has been used to complete the double entry for a business transaction. And it can either lead to overcast or undercast. It is overcast when the wrong amount is more than the original amount. And it is undercast when the wrong amount is less than the original amount. So let's go to the next one now. That's number 5. So number 5 now. Compensating error. Compensating error. This is also very interesting to understand. Compensating error occurs when two errors of the same amount or equal amount occurs at different times, but coincidentally, fortunately, they cancel out each other. Now, let me paint a picture of that. Let's say, for example, sales account was overcast by 500 naira. That means the credit side of the sales account had been increased by 500 naira. And also the purchases account was also overcast by 500 naira. That means the debit side of the purchases account had been increased by 500 naira. So the two 500 naira will cancel out each other, because one is appearing on the debit side, which is in the purchases account, and one is appearing on the credit side, which is in the sales account. So debit side 500 naira, credit side 500 naira, then the two will cancel out each other, and it is same as if there had been no errors in the book. Meanwhile, there had been error. So let's take an example regarding that. So purchases account, purchases and sales accounts, purchases and sales account was overcast by 500 naira. So this is what it means. Sales accounts, then we have purchases accounts. So when purchases account is an expenses account, if it is overcast, it means it's been debited more. That's what it means. And if sales account has been overcast, it means it's been credited more. That's what it means. So since you have been told that the two accounts have been overcast, they've been increased, then you have to undercast it. You have to reduce them. The examiner will not tell you sales account and purchase account have been overcast, so undercast it. No, you will be the one to know that anytime an error is overcast, you have to reduce it. And anytime an error is undercast, you have to increase it. So here now, we have to reduce sales account as well as purchases account. Now, the correction of this error of compensating, most times the correction of it can either find their destination in the suspense account or not, depending on how you want to correct the error. But let me correct it the first way by uh, doing it in a way that it will find its destination in the suspense account. So let's go now. So suspense account now. I want to correct these two errors in the sense that they will find their destination in the suspense account. So sales account had been overcast, we want to reduce it. Purchase account has been overcast, we want to reduce it. So sales account has a credit balance. And if you want to reduce an account that has a credit balance, you will debit it. If you want to reduce an account that has a debit balance, you credit it. So correcting them individually now, that's what will make them to find their destination in the suspense account. So let's correct this error now. That's in sales account. So sales account has been increased. So let's reduce it. So we have 500 here. That's on the debit side, 500. Are we together? So this will cancel out this. Then the corresponding credit entry of this, we go to suspense account. So this is suspense account. Suspense. The corresponding credit entry of this debit entry, which have been used to cancel out the effects of this, we go to suspense account, and that's the credit side. So you come, the particular is going to be sales. Then you have 500 naira. You can see it's ended up in suspense account. The same with purchases. It's been overcast by debiting. Then we want to reduce it now. We put 500 naira here. Then this will cancel out this. Then the corresponding debit entry of this credit entry, which had been made in the purchases account, to cancel out the effect of this, will be made in the suspense account. So you write purchases, particulars will be purchases. Then you have 500. So the suspense account is self-balanced, 500, 500. This is what we have. This is the correction of error of compensating when you want to make them end up in suspense accounts. But if you do not want it to end in suspense accounts, all you have to do is just credit your sales and debit your purchases like we've done initially. Credit it, debit it. Then on on the trial balance, the two sides will just be equal. One of appearing on the credit side and the other appearing on the debit side. That's that. So this is the correction, one of the ways to correct it, which will make the two balances to reflect in the suspense account. That's that. So I hope that is understood. Then let's take the last one, which is the last but not least. That's 6. Error of complete reversal of entry. Look at it, error of complete reversal of entry. Also very interesting to know, like I've been saying regarding all of that words. Yeah, error of complete reversal of entry occurs when an account that ought to be debited is credited, or an account that ought to be credited is debited. That's error of complete reversal of entry. Error of complete reversal of entry, in other words, occurs when the double entry rule has been violated. And don't forget, your double entry rule states that the debit entry for a transaction should be passed in the account of the receiver, and the credit entry for a transaction should be passed in the account of the giver. So Summary of double entry rule now, which we've talked about in our previous episode. You debit the receiver and credit the giver. So committing this error now means you have debited the giver and credit the receiver. That's basically the error which you have committed. And when you commit such error whereby the account that ought to be debited is credited, or the account that ought to be credited is debited, then you have committed an error known as complete reversal of entry. So this is basically what we mean. Let's say we have cash sales, cash sales, 15 naira. Look at this. The two accounts involved in this transaction is cash and sales. And we all know that cash should be debited and sales account to be credited. Then you went ahead to, this is cash account, this is sales account. You went ahead to debit sales and credit cash. Look at this. Sales account ought to be credited and cash account ought to be debited. But you went ahead to debit sales and credit cash. That's error of complete reversal of entry. But it will still make the trial balance, the two sides of the trial balance will be the same because you have successfully passed a credit and debit entry for a transaction. It will not reflect, it will not affect the agreement of the trial balance. So correcting this error now, let's correct it. Very important, very simple to correct. So this entry ought to have been made on the credits and this ought to have been made on the debits. That's what it means. So to correct this error of complete reversal of entry, you need to multiply this amount by 2. Multiply it by 2. Then 50 times 2, that gives you 100. Then this 100 now, you will credit sales account with 100. Then you debit purchases account with 100. Then we now want to have 15 naira here, 15 naira. So you have 15 naira left here. Or if you do not want to do it this way, let's go by balancing the accounts. Look at this. Let's balance it now. So if you want to balance this now, so we have balance carry down. That's 50. That's to make this side equal to this side. Then you have 100. You also have 100. So for every balance carried down, there will be balance brought forward, which is 50. This 50 here. You bring it forward. Then balancing this now, you have balance carried down 50. You have 100. Then you also have 100. So for every balance carried down, there must be balance brought forward. So this 50, this 50. So the normal balance, the normal credit balance, which ought to have been in sales account, is this. And the normal debit balance, which ought to have been in cash account, is this. So this is basically the correction of error of complete reversal of entry. If you want to correct it, pay careful attention. You need to multiply the amount by 2. Then, if the account had been debited wrongly, credit it with the amount that had been multiplied by 2. And if the amount had been credited wrongly, debit it with the amount that had been multiplied by 2. That's that. So this is the correction of error of complete reversal of entry. So these errors, when any one of them occurs, it will not affect the agreement of the trial balance. It will seem as if there were no errors in the books. Meanwhile, there had been errors, but the trial balance will not show that because the trial balance is only extracted basically to test the arithmetical accuracy of the postings in the ledgers. So these are basically those errors. Don't forget, I did say errors that do not affect the agreement of the trial balance or errors that will not be disclosed by the trial balance or errors that will not distort the agreement of the trial balance. So this is where we are going to be drawing the curtain for today. Subscribe to our YouTube page if this is the first time you are watching our video. Like our videos. Continue to support us by helping to share our videos to friends and relatives. Ding the notification bell so that each time we put out a video, you will get notified right away. So from me to you, it's bye from me. I'll see you on my next video. Do have a good one. Bye bye.